Hello, Patrick Walchuk here, and we've done a financial analysis on a three-unit building in Heron Park that sold in March of 2026. And as we do every month, we're going to provide you with the financials and a bit of an interpretation as to what those financials mean. So we'll get right into it, and you can see what happened. So this building, again, it's a pretty typical triplex for the neighborhood, and that neighborhood, by the way, it's got it's a great neighborhood for rentals. Got lots of students in there because of the proximity to Carleton University. It's got people who live there. Other tenants are professional people, so it's a great location for that kind of thing. And this building had two units in it, two bedroom units in it, and one bedroom, and that would be in the basement. And again, that's very typical for this neighborhood. So it was listed for $849,900. It sold for $100 over list price at $850. The scheduled rental income on it was $75,600, and when you deduct for 3%, we come down to $73,000. That's for bad debt, basically, and the operating expenses on that, the stated ones from the agent, were $12,400. And when you factor in another 10%, 5% for maintenance, 5% for management, that gives us total operating expenses of, call it, $19,700, and that gives us a net operating income of, we'll call it rounded up to $54,000. So what does that mean? And it means that it's got a cap rate that I would have expected for this neighborhood of 6.3%, and the operating expense ratios are really low. I would have thought this would be much higher, so this is great for the buyer. The operating expenses are, call it, 27%. It sold for 12 times the gross and 16 times the net, which is really quite low, which indicates to me that the property would need some work. Now, what we usually like to do is look at what's the minimum down payment this property could have in order to be cash flow positive. So we had to stop at 20% here because CMHC regulations are that a multi-unit building that's not going to be owner-occupied needs a minimum 20% down payment. And that's how we're looking at all of these properties, as being investments only, not owner-occupied. So we had to use a minimum of 20%. Now get this, with 20%, that's $170,000, and the mortgage payment on that per month is $35.77. When you extrapolate that out, what is that on an annualized basis? That's $42,924. So this buyer, that's his annual debt service, okay? If he had a 20% down payment, he's going, or she, will generate $10,668 profit per year, which is an ROI of an unheard of 6.28%. So you got to think that this property needed a little bit of work.